Welcome to this explainer. Look, if you're just holding your digital assets in a wallet right now, you are literally leaving money on the table. Today, we're popping the hood on a really clever financial mechanic built straight into modern blockchains. It's a system that lets everyday users earn yield just by helping keep the network secure. We're going to break down exactly how it works, the potential upside, and of course, the very real risks involved in crypto staking. Let's get right into it.
Earning crypto while you sleep? I know, it sounds a little bit like a late-night infomercial, right? A bit too good to be true. But it's actually a foundational piece of how these modern networks operate. You aren't just locking your tokens in a digital vault to collect dust, you're putting them to work. This idea of generating passive rewards is the massive hook drawing millions into the staking ecosystem every single year. But to really grasp how those rewards just magically appear, we need to understand what your tokens are doing while you're away from the keyboard.
So, back in the early days of crypto, securing a blockchain basically meant burning massive amounts of electricity with giant computer rigs. Staking swaps out all that heavy hardware for an economic commitment. When you lock up your cryptocurrency on a proof-of-stake blockchain, you're essentially putting down a giant security deposit. You're helping secure the network and validate the traffic flowing through it, simply by proving, hey, I've got a vested financial interest in keeping this system accurate.
And the actual mechanics of this? It's a pretty seamless, automated loop. First up, you lock your coins, maybe directly with a validator, or maybe you pool them together with other users. Then, the network's algorithm steps in and randomly selects validators from that pool to do the heavy lifting. Step 3 is where the magic happens. Those chosen validators confirm pending transactions and bundle them up to create brand new blocks. And finally, the payoff. Because you provided the capital that let the validator do their job, you get a cut of the rewards. It's a perfect little loop of security and compensation.
Okay, but a blockchain is really only as good as its data, right? So, what keeps everyone playing nice? Well, it's a classic carrot and stick setup. Honest validators who do their jobs and accurately confirm transactions get the carrot, a steady stream of new crypto rewards. But if a validator decides to get sneaky, maybe they try to approve fake transactions or act maliciously, they get the stick. And in the staking world, that stick is called slashing. Slashing literally destroys a portion of those locked staked coins. It makes cheating so incredibly expensive that validators have every financial reason in the world to just follow the rules.
Let's ground this in some real-world numbers, because theory is great, but math is better. Take Solana's native token, SOL, for example. We're not talking about some abstract airline loyalty points here. We're looking at an estimated 7% annual reward. That is a highly compelling, tangible yield, especially when you realize it's paid out in the crypto itself. This number right here is exactly why so many people pivot from just day trading tokens to actively staking them. It gives you a somewhat predictable way to watch your digital portfolio compound.
The math is just beautifully simple. Let's say you start January with 10 SOL. You lock them up to secure the network, you don't buy anything, you don't sell anything, you basically do absolutely nothing, and you end the year with around 10.7 SOL. Your asset is literally working for you, expanding your position just because you agreed to be part of the foundational security layer. Honestly, it's the clearest example of your own economic incentives aligning perfectly with the health of the broader network.
Now keep in mind, the staking ecosystem is massive, and it's definitely not a one-size-fits-all situation. For example, if you're staking Ethereum through a third-party service, your rewards aren't a fixed flat rate. They actually ebb and flow depending on how congested the network is on any given day. On the flip side, protocols like Cardano with its ADA token or Cosmos with Atom are built so you can stake right from their official wallets. That means you get standard network rewards, but keep a totally different level of control over your assets. It just goes to show how many different ways you can interact with this tech.
All right, let's take a step back and be totally objective for a second, because staking is absolutely not without its risks. Yes, the benefits are awesome. You're making passive income, you're boosting network security, and sometimes you even get voting rights to help steer the project's future. That's super cool. But you got to keep your eyes wide open. Token prices can absolutely tank while your funds are locked. Those reward rates, they can and will fluctuate. And honestly, the biggest catch is the lockup periods. If the market suddenly crashes and you panic and want to sell, you might actually be stuck waiting days or even weeks to get your coins back.
So before you rush off and lock up your capital, you really need to run through a quick, non-negotiable mental checklist. First up, do your homework. Research the network thoroughly so you know exactly what you're backing. Second, vet your validator ruthlessly. Remember that slashing penalty we talked about? Yeah, if your validator messes up, it's your coins on the chopping block. And finally, know the exact lockup rules before you commit. You absolutely have to know how long it'll take to withdraw your assets so you're never caught completely off guard if the market gets weird.
So I'm going to leave you with this final thought to chew on as you map out your own crypto journey. We've seen how putting your assets to work secures the whole system, completely ditches the need for energy-guzzling mining, and actually pays you for showing up. But we've also stared down the very real threats of price drops and strict lockups. The tools to earn these passive rewards are literally sitting right in front of you, baked into the very DNA of the modern internet of value. The network has the budget, and it wants to pay you for your security deposit. The only question now is, are you ready to lock it in?